The moat is not the chip. It's 20 years of compounding developer inertia, and it widens automatically every year. Revenue more than doubled twice, while margin expanded each time. That does not happen in an ordinary business. NVIDIA, at its worst recent year, was still 3 times the semiconductor industry median. At peak, nearly 50 times. That is not growth. That is a different company wearing the same name. In this video, we will see 8 charts. Each one has a different angle on the same structural question. What actually makes this margin machine work, and whether anything can stop it? Welcome to the channel, where we break down investing using clear, data-driven charts to track where institutional money is moving and what that means for your portfolio. Everything here is drawn from public filings and long-term data. Analysis only. What you do with it is entirely your decision. Let's go through all 8 charts, starting with the one that reframes everything you thought you knew about this company. Ask 10 investors what NVIDIA does, and 9 say the same thing. Gaming, graphics cards, the GPU company. They are not wrong, they're just describing a company that no longer exists. Look at this chart. Each bar is stacked by segment. Bright green is data center, blue is gaming, the rest barely register. In fiscal year 2020, gaming represented 58% of total revenue. Data center was the minority. By fiscal year 2026, that relationship had completely inverted. Data center commands 90% of a $216 billion revenue base. Gaming has collapsed to 7%. Total revenue went from $13 billion to $216 billion in 6 years. That is not growth. That is a different company wearing the same name. And the segment driving all of it, that dominant green, raises one immediate question. What actually happened inside it? That is exactly what the next chart answers. This chart isolates data center revenue, year by year. There's a dashed vertical line cutting through, marking November 2022, the ChatGPT launch. Left of that line, the bars grow steadily. 2.9 billion, 3 billion, 6.7 billion, 10.6 billion, 15 billion. Solid. Unremarkable. Then the dashed line hits. Fiscal year 2024, $47.5 billion, up 217% in a single year. Fiscal year 2025, $115.2 billion. Fiscal year 2026, $193.7 billion. What that dashed line marks is not just a product moment. It's the moment every major cloud provider, every AI lab, every government building compute capacity ran toward the same bottleneck simultaneously, and NVIDIA owned the bottleneck. $2.9 billion to $193.7 billion in 7 years. The structural question is whether this is a surge or a new baseline, and the answer lives in the quality of the revenue NVIDIA generates as it scales. That is exactly what the next chart shows. 3 lines. Green is NVIDIA, red is AMD, blue is Intel. Gross margin percentage across a full decade. Intel starts at 62% in 2016 and slides almost every year, collapsing to 32.7% by 2024. AMD climbs impressively from 23% to around 52%, then plateaus. NVIDIA dips briefly in 2023, the crypto bust visible between those 2 dashed markers, then explodes to 75% in fiscal year 2025, before settling at 71.1%. Here's the number worth anchoring on. At 75% gross margin, NVIDIA kept 75 cents from every data center dollar before paying a single employee. An H100 chip costs roughly $3,300 to manufacture. List price, $28,000. That gap is what structural pricing power actually looks like. AMD and Intel spend 25 to 31% of their revenue on R&D, trying to close it. A full decade of that effort is visible in this chart. This is the kind of institutional data analysis most retail NVIDIA coverage never goes near. If this framework is useful, SEC filings, cross-referenced, no noise, subscribe. This is what the channel is built on. Now, gross margin explains the quality of the revenue, but it still doesn't explain why competitors can't simply replicate it. The answer to that is not in the hardware, it's in the next chart. Area line chart. X-axis runs from 2006 to 2026. Y-axis counts CUDA developers in millions. Each dot is a confirmed milestone, no interpolated data. CUDA launched in 2006 with 0 developers. By 2012, 1 million had adopted it. The same year, AlexNet, built entirely on CUDA, won the ImageNet competition and launched the modern era of deep learning. That dot is not a coincidence. It's cause and effect. By 2018, 2 million developers. The 2020 data point shows 1.8 million. That reflects registered accounts only, a stricter measure. The ecosystem didn't shrink, the measurement changed. Then watch the curve accelerate. 4 million by 2024, 6 million confirmed at NVIDIA's GTC conference in March 2026. 6 million engineers who have built careers, models, and entire infrastructure stacks on CUDA. Every major AI framework, PyTorch, TensorFlow, JAX, runs natively on CUDA first. The switching cost is not technical. It's a career-level commitment made by millions of people across 2 decades. The moat is not the chip. It is 20 years of compounding developer inertia, and it widens automatically every year. Follow us on social for more long-term compounder analysis and institutional capital breakdowns. But now the question becomes, what does this locked-in ecosystem actually produce in real cash? The next chart has that answer. Green bars show annual free cash flow. The yellow line tracks FCF margin, what percentage of revenue becomes real cash. H100 launch marked with a dashed divider on the right side. In fiscal year 2023, free cash flow was $3.8 billion, and the margin dropped to 14.1%. That was the trough. Inventory glut, crypto correction, the year the bears had their moment. Then the H100 divider hits. Fiscal year 2024, $27 billion. Fiscal year 2025, $60.9 billion. Fiscal year 2026, $96.7 billion, nearly $100 billion in free cash flow in a single fiscal year. And the yellow line tells the structural story. After the H100 launch, FCF margin locked in above 44%, even as revenue doubled twice over. The incremental cost of scaling did not grow at the same rate as revenue. That is the definition of a platform business, reaching operating leverage. But generating cash at this level raises a very specific institutional question. Not how much NVIDIA earns, but how efficiently it has deployed every dollar of capital ever invested in this business. And the next chart answers that, with a number that is genuinely difficult to process the first time you see it. Bars show NVIDIA's return on invested capital by year. The yellow dashed line near the bottom marks the industry median ROIC, 3.02%. Fiscal year 2021, 33.4%, already exceptional by any standard. Fiscal year 2022, 51.1%. Then the red bar, fiscal year 2023, 10.9%, the trough. The bears pointed here and said the thesis was broken. They were wrong. After the H100 launch, ROIC did not recover, it detonated. Fiscal year 2024, 89.3%. Fiscal year 2025, 144.8%. Now look at that yellow dashed line sitting near the floor of the chart. Industry median, 3.02%. NVIDIA, at its worst recent year, was still 3 times the median. At peak, it operated at nearly 50 times the industry median. A business whose moat is eroding does not bounce like this after a down cycle. A business with structural pricing power and a locked-in ecosystem does. The moat held, and the structural reason it held is visible in the next chart. Green bars show absolute R&D spend, climbing from 1.46 B to 17.5 B over a decade. The yellow line tracks R&D as a percentage of revenue. Red and blue dashed reference lines mark AMD at 24.8% and Intel at 31.1%. Here is the counterintuitive insight. NVIDIA has increased absolute R&D spending every single year, and yet the yellow line has been falling since fiscal year 2023, from 27.2% all the way down to 8.1% in fiscal year 2026. NVIDIA now spends 8 cents of every revenue dollar on research and development. AMD spends 25, Intel spends 31. This is not because NVIDIA is cutting corners, it is because revenue is compounding faster than research costs. The existing R&D investment is earning returns across an exponentially larger revenue base. Every dollar of research already deployed gets more productive as the platform scales. This is R&D leverage, one of the rarest structural advantages in technology, and what it produces at the operating level is exactly what the next chart explains. Final chart. Green bars show revenue growth year over year. The dark red bar in fiscal year 2020 marks the one negative year. The yellow line tracks operating margin across the same period. H100 launch divides the chart. Fiscal year 2023, revenue barely grew. Operating margin collapsed to 15.7%. Both lines hit bottom together. Then, after the H100 divider, watch what happens to both lines simultaneously. Revenue grew 122%, then 114%. Operating margin expanded to 54.1%, then 62.4%. It has held above 60% since. Revenue more than doubled twice, while margin expanded each time. That does not happen in an ordinary business. It happens when a platform with largely fixed infrastructure scales into nearly pure incremental profit. The machine becomes more efficient as it grows, not less. One final note. This is structural analysis from public data, not investment advice. Your own diligence always applies. The thesis of this entire video in one sentence. NVIDIA has built a self-reinforcing economic loop. CUDA locks in developers, developers lock in data centers generate margins that fund more R&D, and R&D compounds the lead. Every chart was a different window into the same machine. The question worth sitting with, long after this video ends, is not what the stock does next quarter. It is whether any competitor can dismantle a 20-year software ecosystem before NVIDIA deploys $96 billion in annual free cash flow to extend the moat even further. Historically, the answer has been no. If you found this content valuable, subscribe and hit the like button. Thank you for watching, and see you in the next one.